Terms you should know. This is all pretty basic stuff, but it may be nice just to have you go over this every now and again, because when you're talking to people, you're going to want to just be able to explain this. So the first one is the interest, or the interest rate, right? So that's pretty easy. All you're going to do is you're going to take the interest. This is how you calculate how much money you're going to make. So you have a $100,000 loan. Let's say you charge 10% interest. You take 100,000 times 10. We'll just do that. 100,000 times 10, 0.10 equals 10,000. That's how much you make on a loan. So you take the loan amount by the interest rate, put a point in front of it, point blah blah, 0.18, 0.15, 0.13, whatever you charge. You times that by the amount you lend, and that's how much you make in a year. Now, if you want to figure out how much the points are going to, or the payment's going to be, right? Typically, we charge a monthly payment on the interest accrued every month. So you take 100,000 times 10%, for example, $10,000 per year divided by 12, and your number is going to be $700-800 a month, something like that. Now, that's the interest rate. Most of you will know that. Just remember, interest rate, that's how you do it. We charge typically 15 to 18%, but people charge everything all over the place. Points, that's the most important for you to know. That's how much you will make. Typically, 1 point equals 1%. So if you're doing a $100,000 loan, you charge 1 point. 1% of $100,000 would be $1,000. So most of our loans are 5 to 10 points, of which you'll get 1 to 2 points is what we usually suggest. The loan term for us is usually, that's the length of the loan, is usually 1 year. So again, can be anything. The collateral is the piece of real estate that you're using. So when somebody says, what's my collateral? Let's say it's a residential house, it's a piece of land, it's commercial land, it's apartments, could be anything. That's your collateral, right? The security instrument, this is what securitizes your loan. It's actually very simple. When you're doing a loan, the two main documents you're going to have will be a trust deed or a mortgage. They're both the same thing. The trust deed and the mortgage is the same thing. That's recorded against the property, right? So that, you take a house, you sign a trust deed, a mortgage, you record it against the property, and that is the instrument that gives you the ability to foreclose. Now, the promissory note spells out the terms of the loan. The promissory note will have the interest rate, it'll have the points on it sometimes, it'll have the length of term, it'll tell you when your payments are. That's what the promissory note is. So remember this, the trust deed and the mortgage secures the property, and the promissory note is the terms of the loan. Title insurance, every time we actually lend on a piece of property, we get title insurance from a title company. Basically, that is a huge company that will give you a policy of title insurance, say, yes, you own the property, or it will say, yes, you have a loan against the property. And in the event there's some kind of an issue that comes up where somebody didn't record something or something fouled up, and somebody says you don't have a loan on the property, the title insurance company will actually pay you the money back that you lend on the property because the title company fouled up. So again, trust deed, title insurance guarantees you're in first position, right? Property insurance, that's just the fire insurance. Every time we do a loan, we make sure we have fire insurance against the property or some kind of a casualty insurance so that in the event the house burns down, whatever, you're covered to pay your loan back. And again, we always get our name listed on the fire insurance policy. Legal description of the property, very important. So every property you see will have a legal description. It'll either be meets and bounds, which will say it's 1,000 feet by 500 feet by 1,000 feet by another 500 feet back to the point of beginning. That's a legal description, and it's always referenced to something out on the land tied to some kind of a marker. Or it could be a lot, right? So if your house probably is lot 3 in some subdivision somewhere, that's also a legal description. So that legal description actually identifies your property. Now, each legal description is tied to a tax ID number. So the county categorizes all these legal descriptions. They give it a number, and then the number identifies which property is. So you want to tie these two together. Tax ID is the number of the legal description of your property. Appraisals. It's an appraisal It's an evaluation of your property given by a licensed person that knows how to do appraisals. A BPO is a broker price opinion. So a broker will go out for you, oftentimes for free, and they'll look at the property. They'll give you an evaluation of what it is worth. That's a broker price opinion. We get those all the time. Comparables. Each property will have a comparable, well, not each one will, but when we're trying to evaluate a property, we're looking for other properties that are similar to this, and we try to find out what they sold for, and that just gives us an idea of what the property's worth. So a comparable is another property similar to your property with a sales number of what it sold for. Warranty deed and a quitclaim deed. Those are deeds that transfer ownership. So when you bought a property, you probably received a warranty deed or a quitclaim deed. This is how you ended up getting your property. It's just a deed, kind of like a car deed, but it's different than a deed because they give you a deed. It's recorded at the county. Everyone knows that it's yours. Two different deeds do the same thing. Payoff. When you make a loan on a property, and it's time to pay off the loan, there'll be a payoff letter that goes out. And so you'll just recognize that as a payoff. It's self-explanatory. Foreclosure, as you know, in the event somebody doesn't pay you back, you got to be able to foreclose, take the property back, and then you sell it. And again, trust deed mortgage is what securitizes it so you can foreclose it. Position. It's important. So we only do first mortgages. Every now and again we'll do a second, but very rarely. So the position of your trust deed is important. And again, you may have a first, you may have a second, you may have a third, you may have whatever. You just want to make sure when you're doing a loan, we do anyway, that you're in first position. There's ways and places you can do seconds and thirds, but each one of these trustees and mortgages can go in and out of whatever position you want. So the positioning of the trustee mortgage is important to you. These are just some short, quick terms. Feel free to call me if you want to talk more about them. But get familiar with it. Listen to this a couple of 3 times, and it'll help you when you're talking to your borrowers. Thanks.